All right, thank you everybody for joining us this afternoon at Benzinga. My name is Samantha Gleit, and I'm from the law firm Feuerstein Kulik. We're a small boutique law firm that focuses in the cannabis industry, but we service companies and investors all over the country. My area of expertise is debt finance, which is what brings me to this panel. We focus, again, both on the company and the investor side. Recently, I just completed a large reorganization with Columbia Care, the cannabis company. So that was an exciting big deal that we've just worked on, in addition to helping a lot of other companies figure out how to navigate difficult times in a difficult market when there's not a lot of liquidity available. So with that, I want to introduce our panelists today, and I'll let each of them give a brief introduction. We've got Joe Lustberg from Upwise and Milad Rafi'i from WeCan. Joe, would you like to say hello and give a little background?
Yeah, sure. I'm Joe Lustberg, managing partner of Upwise Capital. Upwise Capital is a full-service debt financing platform. So we have about 100 different lenders on our marketplace, including 40 banks that will lend to cannabis. We do everything from construction loans to equipment financing, line of credit, mortgages, sale-leasebacks, and everything in between.
Hi, my name is Milad Rafi'i. I'm the CEO of WeCan. We are a licensing and compliance consultant, and we also are a broker on the real estate side, helping folks find viable properties that qualify, and as well as a business broker selling their pre-operational licenses and the businesses themselves.
So you guys may have guessed it, but what the three of us all have in common is that we help companies and investors find each other, right? And can help advise on both timing and strategy for when the right time is to obtain capital. And if you're a company or someone looking to get that raise, how do you make yourself attractive to potential investors? And how do you figure out when is the right time to go out there and look for that capital? And also how to express both where you are at in a growth stage and what your goals are in a way that's going to be meaningful and well received. So I'll start out the conversation like this. I think when you think about valuation and how an investor is going to look at your assets, the first thing you have to distinguish is, what is the purpose of your capital raise? Why are you even having this conversation? So for me, most often when I speak to companies, operators, and or investors, they're thinking about taking on a secured loan. So perhaps it's because they want to go acquire another company, or they want to expand into a new state, or perhaps there's been something unforeseen that happened. For example, COVID happened and there's been some unexpected, dips in sales or other things that have affected the cash liquidity, right? And figuring out how to bridge that gap. But there are a lot of other reasons that you might need liquidity, or you might be at a stage in your business where you're ready to sell and you're thinking out, about what is this business worth. So depending on what your context is, that will very much set the stage, right, for how a lender will look at your assets and think about what they're worth. So with that, Joe, can you start and tell us a little bit about, with the investors you work with, what is the first thing that they're thinking about and that you think about when you help make those introductions to find them the right partner for a company with attractive assets?
So it really depends on the stage of the borrower, whether it's a startup or established operator with cash flow or positive EBITDA. But really they're looking for some sort of experience. They're looking for skin in the game, right? So you have to have raised some sort of equity or put your own money into the business to get to the point that you're at. And then most of them are looking for some sort of assets, whether that's the real estate, so they can come in first lien position on the real estate to help you get built out and start your dispensary, cultivation, or processor, whatever it may be. And they're looking for strong guarantors, right? If you're not an MSO in this space, unfortunately, you're going to have to personally guarantee the loan, and really put everything you have into this business. So that's really what they're looking for, is you having everything in this and some experience to execute your business plan.
So just before we switch to Milad, Joe, on that, I have a question about the personal guarantee point. Yeah. When you see lenders and investors asking for that, in your experience, is it because most often they are eager to go take your house and everything you own, or is it more to your point about skin in the game, or is it a mix of both?
It's more, you have to think about this from an underwriter's perspective, right? God forbid you start this business or you're operating this business and a crop goes bad and puts you under, or something happens, they look for the worst case scenario possible, right? In the worst case scenario, they have to foreclose on a building, come after personal assets. You know, most of these lenders are not loan-to-own lenders, but they are making sure that the liquidity is there to cover their loan, right? In the event they do have to foreclose, you have to have enough assets to be able to cover that with whatever property you have, equipment, plus the personal guarantees, right? So it's really not a loan-to-own situation. There are definitely predatory lenders. You know, most of them are going out of business now. But, you know, in our industry, it's unfortunate, but there is always going to be a tax for cannabis operators because the lenders aren't getting their money as cheap as the banks or other people. But there are bank loans available for operators who are profitable, have assets, and are willing to move their deposits to that bank.
So I think a couple of key takeaways, if you have a track record where you can show that you've been operating and have positive cash flow and or positive EBITDA, maybe you have the accessibility to get a bank loan or some other funding because that will certainly get value and be attractive. Or if you have a hard asset like real estate, that might pay off. Milad, what's your advice when you connect with companies, when companies reach out to you and WeCan and say, hey, how do we think about this with respect to when we need financing or how much we're worth? What's the advice you give and what should operators be thinking about?
Well, definitely will vary from market to market in terms of how mature it is. A market like Jersey, we get asked a lot on the front end to put pro forma analyses together, especially when we're doing some licensing work for them. And we try to really build that as conservatively as we can. And for them, it's really, they were speaking to it on panels before, is expecting market downturns, right? And even showing that to a municipality that, hey, we're going to have upside, right? We're going to run this business profitably, but we expect some downturns and we're ready for that as well too. And really driving that home into their pro forma and into their, not only are you want to get financing, but are you getting something with like a 2-3 year balloon when your business is possibly going to see a dip? You know, those are really important things to look at on the front end. Or on the flip side, you know, it's also when you're looking at these emerging markets, there's an easier exit than a market like California, for instance, where there's still a lot of asset value. And you're going to see an increase in that asset value. And even if your business necessarily isn't cash flowing to the point where it's pushing out a lot of revenue to you, you're still going to get that return potentially if you're selling it just purely on the value of the asset going up. But in California, it's different. You got to make sure it can cash flow if you're going to actually have any success from it. So then financing those deals in California or a mature market like that is really more seller financing than anything. And nowadays, you know, I think if you can figure out a way to make the purchase of the business make sense within 2 years, then you're generally in pretty good shape because a lot of sellers are financing about 24 months or 18 months.
There's always the window, right, in each state. You know, typically I always look at it as like a 3 to 5 year window before compression and competition really hits the state. And, you know, somebody who's been in this industry for a long time and has seen thousands of decks, you know, every deck is a hockey stick going up. And the reality of the situation, it's the opposite. It's a hockey stick going the other way.
So what's the right time for someone who's just, you know, getting up and running in New Jersey? And for purposes of this discussion, let's say you're not an established operator, right? Let's say this was your first license. You came, you're new to the market, and maybe you don't have that, you know, positive EBITDA, positive cash flow yet, but you think you're awfully close. What would be the advice and you know, the timeline that someone should think about at that stage?
I mean, we start financing as soon as you get the license, right? If you get the license and you have a piece of property or you're looking for equipment financing, we have solutions to get you financed. But really the best time to look for financing is when you need it, I always say, right? And when you're doing well, right? Like when you're doing and you're super profitable and they're like, oh, I don't need the money, that's the time that you should take it because that's the time you're going to get the best deal from the lender. You know, just to little story is when Massachusetts came about, we saw an operator and we got him a construction loan at 15% plus points from the lender. And he's like, Joe, this is crazy. These are hard money rates. It's absurd. And I said, what's most important to you? Is it, opportunity cost and getting into the Massachusetts market, or is it cost of capital? And he says, cost of capital. I'm going to get a loan from my bank. I'm going to personally guarantee it. And I'm going to secure my HVAC business to do it. I'm like, okay, you could secure all your assets and give them all your deposits, and then you're going to have to raise about $5 million in equity, and then we can do the equipment financing and we'll finance the rest of the equipment. Or you could just take this loan right now at 15% and get built out today. He chose the latter. He chose to go to the bank, raise the equity, and then do the equipment financing. And that whole process took him 2.5 years. By the time he got operational and got his COO, the price per pound in Massachusetts went from $3,000 a pound to $1,200 a pound, right? So the opportunity cost in that scenario was the right way to go, right? If cost of capital is something that's holding you back from moving forward because the cannabis rates are expensive, just understand that the opportunity cost can be a lot more detrimental to your business if it takes you years and years to get built out.
I think that's a great point. Like, timing is everything, and we all know that. And it can be really difficult, I think, to juggle the unknown, right? So many uncertainties in the regulatory landscape. Hard to know. Like, I like how Joe put it, when you're doing the best and you don't need the money, that's when you'll get the best rates, right? Okay, great. So what do we do with that? So Mila, question for you. When you're helping companies think through these valuation issues, I often have to have sometimes difficult conversations, for example, for someone who's trying to go get financing for, let's say, cultivation or greenhouse that they've built out. And they say, well, I've invested $20 million, so surely it's worth at least, 30 because I bought it for 10 and I put 20 into it. And having to sort of walk back and say, well, it's actually not going to be valued that way, and thinking through how someone on the other side may value it despite all of the sort of costs you put in. So curious, like, what comes to mind for you where you might see some room between what people expect that someone else is going to sort of value them at and what might be a more realistic approach?
Yeah, and I hear that all the time, in terms of we've put this much into the business, so we got to get that much at least out of it. And every market's going to be different, but not really. I mean, what it really comes down to is it doesn't matter what you put into the business to get it operational. It's what the business can produce. So, for instance, in retail, if you're looking to potentially have an exit, one of the best times to do it is before you even open your doors, because it's all about the potential revenue. And for retail, there's a pretty big runway you got to have, unless you're a large brand or you have a massive marketing budget in a good location, to accelerate that runway and then be able to justify that cost. Where as a product producer, like a cultivator or a processor or a manufacturer, it's great to have financials to justify what your business is worth, but it's really worth what the buyer can do with it and the potential revenue that they see. And so it's all about what the business can do, less about what you've done and what the pain that you've gone through to get it there. And there's a lot of pain in this industry, and because of everything we've talked about, how long it takes to get operational, and the passion people have. I think Joe made a really good point in terms of getting financing when you're doing great. I mean, that goes for your personal finances, for any business. But in cannabis, I think we do lose sight of that a little bit more, because even when I was doing a pro forma for my store initially, getting into the industry, it was all going up the right direction. I was trying to raise capital, and you believe that. You start believing in that, and you have that good year, and you think, well, hey, per my pro forma, I got a few more years of this, and it's going to get better. But it's probably not. It's probably going to stabilize a lot faster than you expected. So that was great advice, I thought, is really try to remember that in the good times, and always test what you can get out in the market.
I'd like to jump in on that question too there. We see our operators, putting millions of dollars into facilities that they buy for $500,000, $1 million, and they put $15, $20 million into this facility. You know, when you want that much money to build out a facility, it costs you 15 million bucks, you're raising 10 million in debt, you know, you're going to pay the cannabis rate to get a cannabis appraisal and a cannabis value of your facility. You know, so it'll be mid-high teens. But then when you go to that bank to go get that loan later when you're stabilized, the bank's going to look at it as a real estate value on price per square foot in that specific location. What other industrial facilities are selling for that are non-cannabis, and that's what you're going to get a valuation on, right? So
That's really sad. Can you just like walk through that again? Because I think that's an important point, right? Like you put all this money into this great use for this special space, and I think, Joe, what you're saying is a bank is literally going to say, but the lot next door that has nothing on it costs X, and so that's what we're going to.
Yep, that empty warehouse next door is what we're going to lend you. You know, and some banks are starting to understand cannabis a little more, and they'll lend on a loan-to-cost basis if you need, you know, if you're profitable, you're giving them all your deposits, right? But just understand that if you need big dollar amounts above $5 million, the banks aren't doing those loans. You know, their max tickets are $5 million. So your only option, unfortunately, is the other lenders who fund in cannabis and are in their mid-teens or low teens. You know, if you're a very profitable business and you get a 13% interest rate, you should celebrate because you just got a great rate. You know, it's the truth of the matter.
So I agree with that, and this, like, again, is sounding like kind of a sad message, right? Because it's basically like you're going to be stuck paying with these higher than, you know, bank rates on these loans. So I agree with that. I think it's well said. But here's something else to think about, right? So a distinction that I think is somewhat subtle between what Joe's mentioned, what Milad's mentioned, right? How are your assets going to be valued? Well, it obviously depends on who you're talking to and in what purpose. If you're talking to a lender, they are most likely going to say, what is somebody else going to pay me for these assets if I have to sell them in essentially a fire sale? If I have to send a notice out, if I go to Deborah and say, please have Green Market pump out this notice of sale, and I say, give me your best offer in 30 days, what are we going to get? That's also probably a low number, right? But when you're talking about a potential sale, and this also I think rings true when you think about some of the industry-specific lenders that have what we think to be higher than market rates, but they may have more options and put a higher valuation on your assets because they're not necessarily going to say, what does lot 48 next to you go for on the open market? People who have more deeper connections in the industry may have more ability to either, just like a buyer could use that property and say, oh, what am I going to make off this, right? What are the efficiencies? How is this accretive to my existing business? You can also get some of those benefits with some of the industry lenders, even though you are stuck, unfortunately, paying that marginally higher price.
Yeah, I mean, everybody always asks, what about my license? You know, is my license an asset? Can I leverage my license? No, it's not. It's a piece of paper. It's a license and a dream, right? But if you have a property attached to that license, the cannabis-specific lenders will lend you more money than most banks that are out there. So
We need to start wrapping up here.
Okay, well, there's so much we could endlessly cover on this. I think we also just wanted to ask if anybody had questions, because I think the three of us have each gotten a lot of questions, and if not, we can just cover our last point. But is there any questions for either Milad or Joe?
One question?
One question?
I have a question, if that's okay. So, you know, we're talking about acquisition. Oh, sorry, we're talking about potential acquisitions in the future. And when I look, everyone's talking about industry consolidation. You look at a balance sheet or you listen to an earnings call, right, from the usual suspects that we, are imagining are going to consolidate, you know, perhaps acquire some of the smaller distressed assets, right? But if you look at their balance sheet, they're refinancing, you know, they're trading at like 55 cents a share, right? The only reason they have cash in the bank, right, is because they haven't paid 280E, and they're counting on it going retro and being forgiven. We know that's not going to happen, right? So if they're getting, and they're refinancing debt at 12%, right? And so if they're refinancing debt at 12%, in some of these kind of models that they throw at people when they're trying to pick up licenses and acquire them, they're paying the debt, it's cash and then debt at like 8%. That doesn't make sense to me at all. And it shouldn't really to anybody else that happens to be thinking about an acquisition. That's just my 2 cents. I mean, I don't know what your feelings are on that.
Yeah, I mean, I think it depends on what market they're going into. If you're going into a distressed market, then you might be picking up that business for such pennies on the dollar in terms of what you could do as a big operator, bringing down the cost of goods sold and just bringing in your resources to run it way more efficiently than that mom and pop were. And that mom and pop might give you 24 to 36 months financing at 0%. So in those cases, it might work. Now, those groups going into a state like New York or even Kentucky and paying $2-3 million for non-operational business, that's questionable. I think you wonder how they're going to do in those markets if they don't have the funding to go in and continue to fund that operation over and over again, because it doesn't look like a lot of them do from their balance sheets. But I agree.
I'll just add one quick thing, and then I know our time is up. But I think you've pointed out a really good issue, and a lot of those large companies that are actually being the acquirers have large existing debt facilities. So what the takeaway from that is that means those existing lenders are supportive of this acquisition, so much so that they're essentially willing to pay for it because they've got to believe that there's going to be increased efficiency or increased profitability by entering into a new market. So my short answer on that is they have to have the support, which I think is partly your point. You're pointing out how is this happening from someone who's already existing investor in the company.